Hi traders, welcome to Market Outlook Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on what's been happening in markets and what is about to happen in the week ahead. Whilst I'll just let you have a look at the disclaimer, I'll just run through what we hope to get through in the next 30 minutes or so. We'll just follow the normal format. So we'll just see how markets are trading currently. We'll then check out one of the big themes from last week, actually, around the Fed and the potential new Fed chair. So we'll just have some comments about Kevin Hassett, who is rumored to be, the next Fed chair, taking over from Jerome Powell. So we'll just talk about that. And then we'll look at equities and US equities and some of the charts. Before then getting into just a quick forecast from some of the big sorry, not central, some of the big investment banks on what they think or where they think the S&P will finish up next year. So we just got a chart on that and some comments around that. Then we'll get into last week's data points, really some US data. To briefly look at, as well as Eurozone inflation data. And then we'll get into the meat of the webinar, hopefully, which will be the central bank meetings this week. So a preview of the Fed meeting, and we'll look at the dollar index, a preview of the RBA and Bank of Canada meetings. No changes expected to those last two, but we'll still check out what's may be happening going forward, actually. And we'll look at the Aussie dollar and the Canadian dollar as well. Okay, that's pretty much a summary of what we hope to get through. As I said, next 30 minutes or so. Markets generally at the moment pretty quiet, really. European stock markets, they're attempting to move higher after initial pressure, and US equity futures are trading with very, very modest gains. Just checking that out at the moment. The dollar is pretty flat, actually, with the euro and the Kiwi slightly up on the day, but really, really quiet and very small ranges at the moment to kick off this week. Global bonds, they're slightly pressured actually with bunds. Those are German government bonds. They were hit on hawkish remarks from ECB's Schnabel. She's a hawk, of course, on the ECB Governing Council, but she said that she is comfortable on bets that the next move will be a hike, albeit not anytime soon, is what she said. So that getting some coverage in the media, and certainly that goes with some of these central banks now. Other central banks really getting priced in for some hikes actually towards the end of next year. Let me just stress that, but not really cuts anymore with some of these central banks, but then hikes, as I say, towards the end of next year. Crude oil, that's retreating slightly despite a lack of drivers, really. Gold, that is grinding higher, actually, and copper benefits after positive Chinese exports data, though imports disappointed. And natural gas, that hit near 3-year highs, actually, on Friday, spike higher on US weather and cold weather, that is, of course, and also demand for US exports of LNG, but we've slightly pulled back now from that spike high, and we're sort of 5% lower or so in natural gas. As I said last week, I just wanted to touch upon that news really on the possible Fed chair, the new Fed chair. White House National Economic Council Director Kevin Hassett now is reportedly seen as the front runner to be the Fed chair after Jerome Powell leaves in May. That's according to Bloomberg. And from the remaining five candidates, that's Waller, Bowman, Warsh, and Ryder. Hassett, of course, is seen, as we said, briefly touched upon last week, but I just thought I should expand upon it as there was more media coverage. He's seen as having the most dovish profile. He advocates aggressive rate cuts, prioritizing growth of inflation control, and his views are most closely aligned with Donald Trump's. Nevertheless, he has actually stressed the importance of a fully independent central bank. So, really interesting, simply because we had the dollar sell off, really, as it emerged that interviews for the Fed chair position had been cancelled. That kind of news was taken that President Trump had made up his mind. And interesting, as we headed into Thanksgiving, betting markets gave roughly a sort of 1 in 3 chance of Hassett or Waller being in the next chair. And then last week we've seen those odds shot up to above 80%. Also, recent price action is sort of instructive for us, really, kind of giving us a mini preview as to what possibly we can expect if there's a clearer signal that Hassett will replace Powell. As I said, dovish Hassett, so the dollar weakened slightly, the yield curve that also saw some modest bullish steepening, and risk assets kind of gently bid as we've seen going into sort of closer to record highs after that dip lower in US stock markets at least. Um, Interesting as well, though, that's the obvious trade. I guess the slightly different trade to that would be fading dollar weakness, really, on any Hassett announcement effect. And that is ultimately, potentially, we think, because he would not be as dovish or be allowed to be as dovish given the nature of the FOMC voting process. So I know others are talking about that trade as well. So just sort of rumor fact type thing with that Hassett news or speculation and then potential confirmation of that. Although we might not get that till the start of next year, I think was what President Trump said very recently. So that is something to watch out for going forward, of course. Otherwise, equities, if I just pull up a couple of charts, first of all. Just bear with me 1 second. So we've got the S&P 500. Not too much to say, really. Decent rebound from that low, which touched the grey line. That's the 100-day moving average at 65.98. Then we went through the blue line, the 50-day moving average at 67.44. We're just sort of oscillating sideways. Just looks like bullish consolidation, really, before a move higher. We did get that briefly on Friday up to 68.95. So just shy of that record high at 69.20, but we just pulled back a touch. Equities really on Friday pretty quiet again, although S&P or European and US indices actually ended the week almost around 1% higher actually. Um, there was a little bit of a risk on rotation though beneath it on Friday actually. So cyclical sectors they rose roughly 1%, and that was financed by declines in defensives. Um, and actually, if we look at the week as a whole, global cyclicals actually outperformed defensives by 2.5 percentage points, and that was the strongest relative performance since the earnings season. So, yeah, potentially we will push up into these record highs and 69.20, the mark in the S&P. Otherwise, good round numbers there. I said we would look at the projections actually as well. So before we get to that, just the other charts, then the Nasdaq, you can just see similar decent rebound, just a little bit of pausing with narrow range days really, with the record high at 26,182 in the Nasdaq, and then the Dow, excuse me, just pulled up shy of the record high again. A nice breakout of a sort of bullish consolidation pattern there. You can see sort of flag type bullish continuation pattern really. So we had a break higher, then a little bit of a pause, and that's just below the all-time high again at 48,431. That is the Dow. Then if I just pull up the chart that I wanted to show you with some projections, first of all. Um, this is just showing, hopefully you can see this pretty clearly then. It's expectations for, I think it's 11 different not US, sorry, 11 different investment banks. 11, maybe nine, just nine. So a decent number of investment banks anyway. And this is showing really that they all expect US stocks to post, well, another year of double digit gains in 2026. That's kind of defying those jitters, obviously, over very high evaluations in big tech companies and also the AI infrastructure spending that they're doing, and that sort of idea of a potential bubble. Um, so the S&P 500, this is for really, it will rise to more than 7,500 by the end of 2026. That's roughly a 10% increase from its current level. And that is, yes, according to the average of these nine major investment banks surveyed by the FT, by the Financial Times. Record high, as I said, at the moment, hit in October was 69.20. So average then seen at 7,500. Those gains, that would mark the seventh year of double-digit gains in the past eight. But they would represent a slowdown from the sort of 16% or so, 16.5% or so rise that we have seen so far this year, and actually the average over the past decade. All that said, though, the forecasts do indicate a belief, as I've said, on Wall Street, really, that markets have put last month's pullback, which was obviously sparked by those high AI valuations behind them. And this is helped by the prospect of interest rate cuts by the Fed, certainly, and also potentially President Trump's tax cuts. So, yeah, just a guide for you of what a few investment banks, major investment banks, are forecasting for next year, and pretty healthy gains still. I've also kept in this matrix that we showed you last week, actually. So some of you oh, sorry, may not have seen it. Let me just go back, sorry, because here's the chart that I meant to show you. Apologies, I was stuck on pause there. So nine investment banks with the average projection for next year by the end of next year being 7,500. As I say, that is or would mark the seventh year of double-digit gains in the past 8 years. Although it would be a slowdown, as I've said, the 10% gain or so from the 16% or so that we currently have. Remember. Okay. Otherwise, I did have this chart as well. I showed you this last week and just showing you sort of seasonal positivity in December. You can just see only a few only a few instances of December being in the red, negative, otherwise fairly positive, and especially after a negative November, then, although this is only obviously a few instances, but generally December seen as a pretty positive seasonal month for stock markets. Okay, moving on to just some little bits of data from last week before we get into a Fed preview. We had ISM data, quite important, really, manufacturing and services data. Manufacturing fell to 48.2 from 49.0. That signaled continued contraction in the sector, of course. Domestic demand showed further signs of softening, and realized output, while that improved, forward-looking order inventory balances weakened significantly, pointing to negative growth momentum. That was the manufacturing side. For services, they actually rose to 52.6 from consensus estimate 52.1. Positively for the Fed, important this, the price index declined sharply, suggesting easing inflation pressures. Remember, services being a big chunk of the economy, 70% plus of the US economy, and also this is generally a forward-looking indicator. So those are the takeaways from the ISM. We also got other bits of data, ADP jobs data, just for your guide, obviously ahead of non-farm payroll next week. That ADP print decreased by 32,000. We said there could possibly be a negative print. The consensus was for a positive 10,000 job gains. Decline driven by manufacturing job losses, while services employment remained actually quite resilient in this report. And that kind of aligned with the PMI index data rather than what I just told you about the services data. So a bit of conflict there. Also, we had the delayed September PCE inflation data. That was on Friday, but remember it's September data. Core services inflation momentum cooled slightly. At the same time, we had, well, the PCE landed close to expectations. Sorry, core services cooled, so eased back. At the same time, we had confidence data, consumer confidence data, which revealed a decline in consumers' inflation expectations, with 1 year expectations falling to 4.1% and 5 year to 3.2%. And that largely reflected lower gasoline prices. So not many surprises generally in that data, and it really just sort of underpin support for the Fed rate cut that was due to get on Wednesday. Just quickly, otherwise, we did get Eurozone inflation data, and we'll go to a chart actually. Let's go to the euro dollar, which I'll just pull up here. Which you can see here. Just briefly, yeah, November inflation data out of the Eurozone, that came in slightly higher than expected, 2.2% versus consensus expectations of 2.1, and from 2.1 in the previous print. It was a low 2.2 just for your guide, so the actual number was 2.15%, so a very minor upside surprise, really. Core inflation, that remained unchanged at 2.4% as expected, and that was due to services inflation rising, well, 3.5% from 3.4, and goods inflation falling slightly. Interesting, the momentum in services inflation was similar to recent months. So the uptick mainly due actually to base effects, and that is not particularly hawkish. So that's Eurozone inflation data. Just for euro dollar, just for your guide, just traded through the blue line, the 50-day moving average at 116.07. Also now trading around the grey line, the 100-day. That's at 116.43. Not too much importance with these. Maybe the blue line, because you can just see it's sort of supported prices and then acted as resistance and now potentially support. Grey line less so, I'd say. So 116.07, the marker on the downside. If we do break to the upside, then we've got these near-term fib levels in here, with the next one at 117.17 if we can break last week's highs. Okay, moving on from that to obviously the three main central bank meetings. First up, the Fed on Wednesday. Markets fully expect the FOMC to cut rates by 25 basis points. That would be for a third consecutive time on Wednesday. And that is despite widening divisions among policymakers. Around a 90% plus chance money markets give of a move. And that, as I said, would follow previous reductions in the last few months. Although Fed Chair Powell had cautioned at the October meeting that a December cut, if you remember, was far from assured given inflation risks. Of course, we've had a prolonged government shutdown as well. That has delayed key data and added uncertainty to this. And the October minutes as well, if you remember, they signaled a sharply split committee. So we'll just look at that. There's a few things really to look at for this preview. Then we'll look at the split committee and voting members. We do get updated economic projections and a dot plot, so we'll check that out. And then we'll just check out some other thoughts as well before getting into implications for the dollar. Certainly, though, we've got a split committee at the moment. On one side, certainly, and we saw rate cut bets really pick up, really, as we had further reductions really supported by several Fed officials, and notably one was New York Fed President Williams. He's part of the sort of leadership team, if you like, on the Fed, the troika of Powell and Williams as well. And he suggested or recently said that a near-term rate cut could be appropriate. And then if we look at voting members, we note 4 have explicitly supported cuts. So that's Bowman, Waller, Mirren and Williams. One is seen leaning towards a cut, that is Cook. Two have been fairly unclear, so that's Powell and Jefferson, while five are leaning towards a hold. That's Barr, Schmidt, Collins, Musalem, and Goolsby. The divisions really, that means the meeting could produce the highest number of dissents since the early 1990s. So that could be a headline with potentially four or more opposing any rate cut. So just watch out for that initially. Although, if we do get the cut, then that's obviously the big decision. Although this is very split. Then, as I said, we do get updated economic projections and the dot plot. So a Reuters poll points to a lack of consensus in the 2026 dot plot, with medians showing two further cuts, but significant disagreement driven by by the um, disagreement driven by fiscal risks, tariff effects, and concerns over Fed independence. There is as well a wide gap between consumer and market inflation expectations, and that further complicates the Fed's task, with PCE potentially staying above 2% through to 2027. On the growth side, well, the US economy likely grew 3% in Q3, slowing to 0.8% this quarter, and that is forecast to average sort of around 2% in 2026. I think, though, most really expect, or consensus is really for only minor adjustments to the 2026 outlook in the projections, with slightly higher GDP and unemployment and a marginally lower inflation. That would then see the 2026 median dot plot staying at 3.375%, although one lower dot could pull it down with risks tilted slightly to the downside. So at the moment, I think probably consensus is for one more cut in the dot plot for next year. Obviously, if there's no cut, that would be a surprise. Two cuts, a very big surprise. But that is consensus at the moment in amongst that other detail I've just talked about. Um, One other thing to think about, of course, is the fact that the rate outlook will be clouded by President Trump's imminent choice for Fed chair, which is why we talked about that at the top of the webinar. Of course, a strong dovish pick like Hassett that we talked about, closely aligned with Trump's policy stance, then that would increase the likelihood of additional cuts in 2026. And certainly, as we had that pretty much solid confirmation, although not an official yet, then potentially the markets could look through anything slightly hawkish after a sort of initial reaction. We shall see, of course, because obviously that Kevin Hassett appointment is not official as yet. One thing to note on that as well, I should have mentioned actually, is that Hassett, um, and here's the chart, sorry, with the Fed. Hassett has had some questions raised around him simply because bond investors have warned, well, he may push for aggressive easing, raising the risk of higher inflation and the Treasury sell-off, but then concerns are focused on his perceived lack of independence, limited market focus, and an ability to manage a divided Fed, raising questions about its credibility. So those are very recent sort of issues that may or have been risen even against what I said earlier about the fading potentially as a trade once or if it gets announced. So just a few things to bear in mind there. Here's, yeah, that chart with just the benchmark interest rate at the moment, of course. That's the midpoint, of course, of the target range. And then we've just got inflation, both core and CPI, at 3%, so well above that 2% target still, and slightly picking up, as you can see from those lows earlier on this year. For the dollar, market pricing, well, yeah, if we just pull up the dollar chart, actually, first up. Just bear with me 1 second. Yeah, so here's a dollar chart. But for market pricing, just for your guide as well, I always like to go through this. At the moment, currently only see around 14 basis points of cuts at the March meeting, and then an additional 33 basis points of cuts by the June meeting. So that's basically one cut and a half, if you like, by June. Um, which is interesting, and that'll be a focus for those dot plots, of course. That means it kind of means, yeah, for a market that seems to have so casually priced in an extension of the Fed easing cycle into next year. Perhaps this meeting will be a kind of reality check with Fed thinking, um, uh, yeah, potentially that there are upside risks for the dollar, because ultimately the Fed could easily, after three back-to-back rate cuts, of course, cite the fact that the policy rate is much closer to neutral, requiring some kind of pause in the rate cutting cycle, or at least a hint at cutting rates at alternative policy meetings. That is probably the risk and potential move in the dollar for a Fed if it's just sort of is more cautious. Um, and certainly, as the October FOMC meeting showed, press conferences can prove quite dangerous for, well, dollar sellers, dollar bears. And in a way, it's possibly hard to see Powell delivering a more dovish than expected uptake given the dissent within the Fed. That is key. That's why we talked about those different voting options as well. But this potentially would may only be short term, and an immediate reaction after the Fed, really. Um, um, as what we could move on for a couple of reasons, really. That sort of dovish setup that the Fed will potentially have with Hassett and others, new members coming on board, and then also just a simple near-term fact that year-end seasonality generally sees dollar weakness. And if, say, we get some soft US jobs data, which is on December 16, then say a rate hike by the BOJ, then potentially, yeah, we get dollar yen moving lower, of course, and euro dollar sort of sticking around the 116 and above. For the DXY, this is the chart you can see on here. We're below the black line, which is the 200-day moving average. That is at 99.47. We've got some long-term levels in here around 99.57 as well to sort of reinforce that resistance zone. We're just trading now below the blue line, the 50-day moving average. That's at 99.16. Again, looks like potential just bearish consolidation before a move lower. So the grey line's the 100-day, that's at 98.59. Otherwise, probably this swing low from middle of October, that's a 98.03. That'll be a target for the bears. And then obviously long-term lows towards 96. Okay, moving on from that then to the other central bank meetings as well. Aussie dollar chart here. We have the RBA meeting later, well, overnight tonight, really Tuesday. Money markets fully pricing in that the bank will keep the cash rate at 3.6%. Policy was unchanged at its November meeting as expected with a unanimous decision. At that time, the bank said inflation had recently picked up and domestic economic activity was recovering, but the outlook remained uncertain. The board also judged it appropriate to stay cautious and remained alert to the heightened uncertainty in both directions. The bank, the RBA, they also released its quarterly statement on monetary policy. That was interesting because it showed a sharp rise in core inflation forecasts um, from, well, just looking at those inflation forecasts, yeah, through Q2 2026, raising, yeah, the core forecast and then the June 2026 trimmed mean seen at 3.2%, previously 2.6, and then June CPI at 3.7, previously 3.1. So some sharp upward revisions to their forecasts in the quarterly statement. Um, and that's what we've had most recently. We've then had bullish after that previous press conference, basically saying they had not considered rate cuts and the policy bias. They didn't have a policy bias and believed it was in the right place for now. Central bank language recently as well that signaled continued uncertainty over future policy and a willingness to keep options open with no urgency for an immediate adjustment. Certainly, their markets will scrutinize the RBA's language and tone at the press conference. And money markets now, we have had recent hot data as well, just for your guide, of course. Money markets have shifted now, and they don't see any further rate cuts at all, really, with the next move more likely a rate hike, but not until the second half of next year. We've seen that pick up in the Aussie against the dollar. Then you can see consecutive days of gains. I think it was 10 out of 11 of the last days have been up. So we found support at the black line, the 200-day moving average of 64.72, and now we suggested that this was a sort of wide range between sort of low 64s and high 66s with a break above that very briefly and then pull back into that range. So we're at the top of the range now, which is around 66, just above there. Of course, that's high from mid-September was 67.07, just for your guide. But potentially we are slightly overbought as well. So whether we just pull back to the range and range trade could be a trade going forward and quite interesting. Otherwise, just moving on quickly then finally to dollar CAD, this chart, and the Bank of Canada rate decision. Again, as I said, expected to maintain rates, sit on their hands with rates at 2.25%. Excuse me. Since the last Bank of Canada meeting, then views on policy direction have been little swayed. We've had jobs, CPI data hotter than expected. And that's paved the way really for the Bank of Canada to pause and await the impact of the recent easing. The bank, they did point towards a hold in the last statement. So current policy rate is at about the rate to right level to keep inflation close to 2% while helping the economy through this period of structural adjustment. Growth data since the October meeting has likely been welcomed by the bank. September GDP metrics matched expectations, while the Q3 reading annualized figure was notably above forecasts. Money markets, then, they largely price in a hold at this meeting. And then looking to 2026, well, since the November jobs report, which was very hot last week, markets have shifted to a hawkish stance, really. 15 basis points of rate hikes now priced in, following that big drop in the unemployment rate to 6.5% from 6.9, and also a hot headline print as well. Before that data, actually, some easing was priced in by mid-year, and that's now completely reversed. So that's where we saw, you can see big move down in dollar CAD. So the Canadian dollar strengthening there on Friday, moved down through the 200-day and the 100-day moving averages at the bottom of this sort of ascending channel. That's around 139, just above 139. So we dropped down through that channel, which negates it really, and that level now acts as strong resistance really. And we're now at a minor fib level of this year's high to this year's low, that minor fib level around where we're trading currently, actually around just above 138. Otherwise, then you've got the lows from June at 135.38, much lower. So you've probably got some swing lows here from mid-Sep, 137.26 to look out for if we can maintain this move lower in dollar CAD as the loonie strengthens against the US dollar. Okay, I'm going to wrap it up there. Thank you so much for staying with us. Do hope that has proved of use to you. Please do follow us on social media, and also we do put out a daily commentary on the website after the US close. Um, Yeah, lots still happening in markets, certainly with the central bank meetings. And then also next week, we get that non-farm payroll data. We will be back, not same time actually on Monday, but next Wednesday. So we'll be reviewing these meetings, no doubt, as well as the data as well. So please do tune in then. Take care, and we will speak to you soon.